Howdy, Jacob here. Today we're looking at Shockwave Medical, company 116 of our high ROIC screener, healthcare equipment and supplies industry, just under 12 billion market cap and enterprise value. Pretty small company on the revenue side. They are still $12 billion company, so pretty big there. But gross margins recently have been very high, over 80%, with operating margins in the 20% range. Very impressive. Return on invested capital is 15%, but in 2022 is as high as 50%. Growth is outstanding, and it looks like, I guess it's gone down a little bit, but still very heavy on the growth side. Balance sheet shows about a billion in cash-like products with 898 million in total liabilities, so very safe on the balance sheet. Cash flow shows a good amount of reinvestment back in the business, a little bit on the acquisition side, heavy issuance of debt here through them reinvesting, but still not a concern given that we saw the balance sheet was very safe. They're just starting to make some money, so we're not looking at a long history. So we might have to increase our margin of safety through the discount rate and possibly making more conservative assumptions. But we're looking at heavy growth years. And I mean, it is tough when you're not looking at a lot of data. We don't see that, there's 10, 20, 30, 50 years of history of consistent margins and such. So it's going to be a little bit riskier of an investment based on the fact that we just don't have a whole lot of data to work off of. But let's start making some assumptions here. So revenue growth, I could easily see it grow 20%. I mean, it's in the healthcare equipment supplies industry. There's going to be heavy growth there. It looks like they develop and commercialize intravascular lithotripsy. I don't know how to say all that, but okay. Company's incorporated in 2009, so pretty new company, pretty large for as new as they are. Margins, let's say that we'll do a pretty big range here because I don't know what to expect. 2% share change, I think that's reasonable given their stock-based compensation, and maybe they might issue a little bit to reinvest. PE and price free cash flow at the end of 7 years, I could probably see them have quite a bit of growth ahead of them still. So even with 20% revenue per year, 25 PE at the end of 7 years, 15 and 25% margins, it looks a little bit expensive. We're saying it needs to fall 6-9% to get the return we're looking for. And these companies are hard too, because when you have as much growth as them, it can be fantastic if you buy it for an amazing price because it's going to compound like crazy. But you're really banking on very heavy growth, which can be very tough. But it just seems to me at this price point just looks a little bit expensive, but definitely an interesting company and one that has a lot of growth ahead of them. And I think that that much growth is amazing, but everything is the price you pay for it. And I just think at this price point, a little too much for me. Hopefully you enjoyed the video, and I hope you have a great rest of your day. Thank you.